You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host. As always, we've got Vanessa Rader from Ray White Commercial back in the room. She's our guru on all things commercial research on a national basis as well. And we love those national perspectives because it gives us context about how our market in Western Australia is going. Vanessa, thanks for coming back in, mate.
Thanks, Trent.
It's been a good 3 or 4 months since you were in last, and last time it was a bit of a wait and see going into the election when we were speaking about how the commercial market was going. A little bit of a slower year up until early 2025 with regards to transactions, high interest rates making it tougher for buyers and sellers to come together on prices. But we know we are now post-election, so a bit less noise. We also know we're in a rate cutting cycle despite what happened a couple of weeks ago with Michelle Bullock's team. What's been the feel on the ground in the commercial space across all of those uses? We know we can talk about retail, about fast food, about petrol, childcare, large format warehouses, offices.
Big question, I think. Very big question. It's interesting that you say about this holding pattern that we've been in, because that's certainly where we've been for the last 2 years. I just looked at all the transaction activity over the last financial year across the country compared to last year, and we're sitting pretty much exactly the same amount, so about $60 billion worth of transactions. And I'm talking about a marginal increase year on year. So not
is that
much
a lot of transactions in terms of volume over a 10, 15, 20 year period?
No, it's not. So if it gives you some context, during the COVID period, which obviously was hysterically high, was about $130 billion. We're less than half of that now. If you look at it over longer term, it probably sits more like $80 or $90 billion. So 60 is pretty low. If you look at WA alone, we can see that the transactions have been about $5 billion, and that's been about 5% increase on last year. So not much has really changed in that regard.
That's interesting you talk about the $5 billion, just under 10% of the Australian population. Our residential space with regards to resi transactions is about the same. It's interesting to note that our commercial space clearly is in step with that.
Yeah, it is. But if you have a look at your makeup of what have you been buying in here, it's actually quite different compared to the rest of the country. So we all know that retail has been the asset class of choice over the last 12 months. I've certainly been talking about that quite a lot. I'm talking about actual retail centres. So in WA, you've had a large number of larger centres like Westfield type centres that have actually transacted, so that's brought your volumes up quite a bit. You've got your large format retail centres and neighbourhood centres as well, and also your strips and the normal shops that you see on the street. It's been a big year. Nearly $2 billion of that investment has been in retail off the back of a couple of large centre deals, and that's by far the largest component of your spend.
So if they didn't happen, we'd be even lower.
Yeah,
obviously.
100%. And so industrial sits at about $1 billion. So historically, industrial's always been the biggest part of the market, and we can see that's half the amount of what retail's been this year.
Why is industrial so low?
I think that people aren't selling. It's not a matter of people don't want to buy. It's a tightly held market. Not a lot of new stock, obviously. Not a lot of land supply available to build new stuff. Also the cost, obviously, to develop a bit prohibitive at the moment. So, yeah, there's limited stock and people willing to purchase. But $1 billion in office again. Historically, office also. All it takes is a couple of big office buildings to sell, and that can really skew the numbers. But, yeah, no big office deals have happened in the last 12 months.
And so there's two reasons, as you're saying. In some spaces, the reason is no one wants to sell. And in other spaces, it's those that want to sell higher than what people are buying for. There's just a big spread there at the moment.
But I think over the last 2 years, they've been worn down, if that's a good way to say it.
Have the buyers been worn up, or have the sellers been worn down?
It's really the sellers have been worn down. Okay. So if you need to sell, you need to sell. People have been in a holding pattern for an awful long time. It hasn't just been the last 2 years. So if you need to sell, you need to sell. There's always lots of reasons for people needing to actually transact. But now we've got this period of time, like you said, it looks like interest rates are moving in a downward trajectory. And I know we didn't say that last month like we all expected it to, but people are feeling a bit more confident that the financing is going to be there. Finance is going to be more cost effective. So maybe now is the time to make that decision and buy.
So we're at the end of a price adjustment phase, and we expect now that there'll be a bit more energy from the buy side to come closer to the sell side.
I think so. But in saying that, late last year in 2024, we did see that fourth quarter quite a lot of transactions occur. So that kind of felt like the start of something, but it didn't really eventuate. And that's not just a WA story. That happened around the country. There was a few really big office transactions, for example, in Sydney and in Brisbane. And everyone thought that was going to be the start of recovery in terms of transaction activity. But despite interest rates and movement, obviously, at the start of the year, there was still this uncertainty in the market a little bit. bit. So people still have remained in this holding pattern, which we do expect we are going to be coming out of now.
For everyone, commercial and resi, that first quarter of 2025 was a bit of a holding pattern. There was just so much noise, especially in Western Australia. State election, federal election, Trump craziness, ongoing war issues. Everyone just had that first quarter in 5 years, I think, where they took pause, had a bit of a think about what's next, waited to see what was going to come out of this big mess. But what we know is that what is coming out is really not much different to what was it last year. As you said, transactions are the same, but the fundamentals. Talking to the resi space, and I know a lot of listeners love the updates on the resi, even if we're talking about commercial, we're back down a week or so away from being at the same number of stock on market in the resi space as we were a year ago when it was at its historical ever low. We didn't expect to be in that position. Do we see ripple effects between the resi market and the commercial market? I know there can be correlations when it comes to GDP growth and how everyone's feeling about their money, but do we see ripples on confidence or people missing out on resi so they go to commercial or back and forth, or is it really two different markets, two different buyers?
I don't want to sit on the fence with that answer, but you're right. And just back to your point on the first quarter of this year, when there's all this uncertainty going on in the economy, the easiest thing for people to do is sit on their hands.
Especially in commercial. It's not like you need to
Especially
live
in
in
commercial. That's right.
Yeah.
Like, we can just wait. There's no urgency. If I'm just waiting, chances are the other person that potentially is buying is just going to wait too. So it just takes the urgency completely out of the market.
And they're more sophisticated buyers. They have to be. It's bigger numbers. It's more complex stuff to understand and wrap things around. If you're buying commercial, you're probably already quite a prudent person most of the time. And so you've learned that skill to just wait.
Yeah, that's right. But when it comes to resi, it's really interesting to see, because I've been looking at a lot of our resi data, obviously at Ray Wyatt, and how much has that Perth market, house unit, doesn't matter, regional, metropolitan, had the greatest growth of any city, state in the country, and it's so consistently high. Looking at those listing numbers, like you said, historic low, really difficult, but we continue to see that population growth increase. Employment still looking reasonably good here, and people need somewhere to live at the end of the day. So
we had a lot of people betting against us, Vanessa. A
Yeah.
lot of Melbourne quote-unquote experts betting against us. But the reality is I think Western Australians are more informed, hopefully a little bit because of this podcast,
Yes.
than they used to be. And they listen a little less to the pundits from your Christopher Joys, who is always betting against Western Australia, or not even including us in the conversation, as well as your buyer's agent experts who've got their YouTube channels and things, who at first moment they can will try and drag those buyers back to Melbourne. How does the Melbourne-Sydney market
Well, let me tell
compared
you,
to Perth?
I do agree with you. There is always a lot of hesitation around Perth, particularly if you're an East Coast buyer, because historically your economy has been very peaky and trophy, and they can be quite big swings. However, time has shown us over the last little while that your consistency has been strong. The growth has been moving upwards. All those economic fundamentals are very sound for WA, and you're not building just like everywhere else. In terms of other states, like I said, WA moving ahead of any other place in terms of growth in housing numbers. But if you look at somewhere like Melbourne, for example, I don't like Melbourne. I put it very clearly. I just don't like the place. So I wasn't upset to see that it's got the record high vacancy when it comes to the office market. No one goes to work. I can talk about this all day. But that market, they've had a real correction in their housing prices. Like, it really hasn't moved for the last little while.
I characterise it with the word malaise. There just seems to be malaise over that whole city.
But in the last couple of weeks, can I tell you, if you're looking at our auction results, our registered bidder numbers, our active bidder numbers, it's all increased really substantially. And if you speak to the agents on the ground, it's all interstate investors jumping in on that market. They can see opportunity there, because at the end of the day, Melbourne is a big economy. There's tax issues with it, and there's a lot to dislike. Vacancy was 18% in office, but they are jumping in because they can see opportunity now in those markets. Even Sydney growth really slowed down, where now people are jumping back into Sydney and Melbourne looking for that next level of price growth, because Perth has been consistently growing higher, same as Queensland, and even to some extent South Australia.
So people are just speculating that at some point Melbourne has to bounce back. But I would suggest, and look, it very well could be that, but I think Perth has proven the point both ways, that things don't just bounce or pop because at some point they should, because, we've had a few years. It only happens when the market sorts itself out or overcorrects or doesn't. And we generalise most of the time that after a couple of years of growth, the market will oversupply and we'll see some drops. But again, that's not happening in Perth. We haven't fixed our problem in the resi space. We haven't fixed that in the industrial space. space, we aren't fixing it in the commercial space because no one's building and no one's getting the land on from the commercial and industrial space.
And
now,
to be fair, that's the same story everywhere except for maybe Melbourne, because
that's the point I'm making.
They do have the potential to become in an oversupply situation. That's the only market that was actually building homes over this last little while.
They're actually the highest growth in construction in housing in the country.
That's right.
Look at Sydney, the lowest, 1.5% growth. Now, that actually supports the argument for, there is actually some growth sitting there in Sydney because they're not solving their problems. I guess the point I'm making is that people are betting on Melbourne because it should come back. It has to come back.
History will tell us.
Exactly.
Yeah, I get your point. And because there is so much land availability in Melbourne as well, like they can keep on just drawing that line around the city and just keep on going out and out. Similarly for industrial. Whereas, you've so much, I don't want to say red tape, but I've just said it, in WA in terms of having to develop, for resi or be it for industrial, for example, and the servicing issues that go along with it, which Sydney has a lot of those same issues as well.
Well, examples in Sydney where housing estates are 4 years down the track without being serviced with water. We struggle with similar things in Perth, and Sydney is the canary in the coal mine for us. Commercial and industrial land generally doesn't come out until you've built your resi as well, and we've only got a couple of state-sponsored industrial estates, one up in Neerabup, which is northeast Wanneroo, and one down near the Henderson Marine Complex, Orion Estate. Now, there's one being built out in Kidale, Maddington space, but other than that, again, we don't have a lot of options. Commercial doesn't just come out of nowhere. It comes from residential land being developed and commercial just being plopped in the middle of it. But that doesn't happen until sewer gets created, Western Power gets off their ass to do their work, and then developers can actually get things done. So it is to actually, when you think about it, a lot of the supply side is tied in with the residential side because that's where all of the money and the tractors come from in the first place.
Yeah, absolutely. Like just leaning on a Sydney example, we've got the great Western Sydney Airport, which is just about done, and it's a huge facility, yet there's all this land around it that is not serviced for them to do employment lands around it, and it's such a long runway, excuse the pun, until that actually comes out of the ground for it to actually be a vibrant hub that the airport is supposed to be. So it's a frustration that servicing also just adds to that cost to develop as well, which then comes into what happens to rents.
Yeah, that's the point here. What does happen to rent, Vanessa? Rent's obviously increased substantially in the industrial space. In childcare, over a 5-year period, they're probably up 50% as well. In petrol, we know they've increased. QSR, they are increasing. But if we look back from 2030, are we expecting to see a stagnant rent, or are we expecting to see a material step change in the same way we have seen a material step change in the cost to construct?
I think there will have to be that change. Otherwise, people aren't going to develop. That new economic rent is going to be set by the cost for the land and also the cost of the developing the product. And we know how long and how hard it is to get product out of the ground at the moment. So in order to make it stack up, no matter what asset class it is, it needs to have that premium in terms of rent. What does that mean? Do all the markets then have a two-tier situation where you have the brand new premium, super expensive than everything else? Perhaps that's the way the market's going to be. And that's also going to then lift up the other prime stuff behind it. So there will be always this super prime, if you like, of industrial, whatever it is, childcare, and then there'll be the prime, and everything will eventually move its way up.
It's tough, isn't it, to be a brave market leader in that? Just because if you're buying a hamburger from the super prime new location or from a location that's 10 years old, the burger's still the same. If you're getting a gym membership, the treadmill's still the same.
Yes.
You don't know whether that building costs double than what the last one was 10 years ago. As long as you've got your membership, it's the same. And I think what it does, it just creates this real precipice where nearly no one's expanding their footprint as a national tenant. They're buying each other out. For example, we've seen Revo Fitness buying out a whole bunch of places in Melbourne because it's probably just cheaper to do that than build new gyms.
100%.
So I think we're going to see this cannibalization in the industry of the best and most efficient tenants, national brands, starting to really conglomerate and create these super monopolies because nothing can get built for everyone else to be able to expand into. And the developers are sitting there going, well, in time you'll have to pay the rent. But right now it's just this cannibalization of the industries.
And if you look at somewhere like an office market, the new products that are coming out of the ground, the rents that they're mental. I've got
a great example in Perth. There's a proposed office location just down the road from me here. Now we pay a rent about 3K out of the city that starts in the early 100s per square metre. Now that's cheap.
Yep.
A lot of the places in Subiaco, Leederville, you're paying in the 200s. Maybe 3 if you really have prime. For new stuff coming up just down the corner, based on the construction cost, the office space would have to be like $400 and something a square metre. It's just markedly higher than anything else. And all we're talking about is 4 walls and a place to be on my computer all day. When do you actually see that step change happen in office, especially when there's still so much B, C, D grade stuff lying around?
It's such a hard one to understand because I do worry, particularly in markets like Perth or even suburban markets in, say, a Sydney or even Melbourne, full stop, because there isn't the occupancy levels there. And also, when we've got working from home, people are trying to consolidate their footprints. People aren't generally moving. Sydney's Perth examples too. When there's a new building being built, they're being able to attract these tenants there. I don't know how because of their prices are huge, but they're attracting them with these smaller floor plates, like smaller footprints. So you're moving from a larger footprint to a smaller footprint because it's more efficient use of space. So no consideration for the growth of your business or for people to actually come back to work, because if they all came back to work, there'll be nowhere to sit. You'll be sitting in the kitchen, sitting in the foyer.
Is there a view that will happen though?
Yeah, we're at a spot where people have moved into these premium buildings and now there's not anywhere for them to sit. And so they're furiously...
Are people coming back to work?
People are coming back to work.
Because it was never really a huge issue here.
Yeah.
It was clearly more pronounced in Melbourne City.
But this is the thing. If you, like your example down the road, if you're charging for something for it, you need someone to go, oh, I really want to be in that space because it's going to be really schmick and really lovely and really convenient.
It's a flex
rent,
but
then it's going to be, I only need half the amount of space. But it's hard for people to be able to do that because you've come back into work here in WA. It was never a big issue. Sydney, not everyone's back, but people are back and people are starting to run out of space because they did consolidate their size. Melbourne, if I can shit on Melbourne for a second, they're not going to work. Unless there's a lunch involved, they're not going to
Not
the
interested.
office.
Does that inflation in the rent space then just eventually get passed on to consumers? Are our burgers going to get more expensive in 5 years as these step changes start happening at memberships? Doesn't it all just flow through eventually to the consumer?
It does. And we've seen it with the increase in like minimum wages and all that stuff too. That's already been passed on. Yeah, I think that we will, because the burger place needs to sell so many more burgers to justify that new rent. And if they can't sell that additional amount of burgers, but then you need the staff to do it, you need the outlay as well to do it, you need to put up the price of the goods. So it's a bit of a never-ending cycle.
Yeah, it's a race to the bottom in that space, but then life always seems to continue in that we just accept inflation over time as consumers and it runs through the B2B until it becomes B2C.
Yeah, it's a super interesting time to see how things go because people are still spending. If you look at the retail trade, for example, we are coming back in terms of what we're spending. People are still spending on food. People are still spending on those kind of services. People are still getting their hair done. They're doing their nails and all the things. Discretionary things. If you're really doing it tough, you weren't doing that. But where we are seeing people cut spending, like big white goods, people are totally okay with doing secondhand now.
So like Harvey Norman-based things.
Those sort of things are doing it tough because things like Facebook Marketplace, before you don't want to buy a secondhand whatever, people don't care now. If they're going to save money and they know it's only going to last 2 years and I can just get another one secondhand, people are jumping on and actually doing
fashion.
that. Exactly.
Got you. Okay.
That's an interesting change because then what does that mean for like the large format retail as well?
Yeah, and it makes it really hard because those large format retailers, like your Spotlights, like your Harvey Normans, your Domains, your big places, they're your anchor tenants for getting new centres up in the first place, aren't they?
Yeah, but you're relying on that new residential buyer that needs to kit out their whole home, but the volume of transactions are down because they're not on the market, so there's less of them, and they're probably buying at the max so that they don't have a whole lot of leftover money to buy a new couch and all the things that you do to furnish a whole home. So it's an interesting one. It's all linked.
That has been an interesting change in consumer preferences since COVID, is that in times where people have said they're doing it tough, and let's say that has been the last couple of years as rates have been high, especially, and rents have been high. Normally, as you said, you would see people cooking at home more and cancelling the gym membership, getting their own home gym. People aren't doing that anymore. They're just happy to live like kings and figure it out the rest of the week.
Yeah, there is a lot of that. And you have to look at our tourism numbers. People still go on holidays. They may not be going as far, seeing some of these Southeast Asian countries. I think Vietnam's now in our top 3 places that people travel to.
We do it a lot more than our
parents
did.
But we do it more. 100%. Every year there's not this guaranteed Europe trip. How many people I've heard they're going on an African safari this year is ridiculous. Seems like such a bucket list item thing to do, but there's a lot of people doing these big holidays. So yeah, where's the cost of living crunch for them?
Yeah, so the question is, how does that come out in the wash, pardon the pun, with regards to where the opportunities are lying in commercial and industrial? We've spoken about the idea of the bigger brands cannibalizing the small brands as tenants and essentially just soaking up supply, if there is any, in the existing floor plates of commercial areas. Where do I want to be if I'm a commercial investor right now going forward, where there's opportunity to buy and there's opportunity for growth?
That's a pretty loaded question. Anything I still like industrial. While there may be limited opportunity there and you'll probably be paying a high price, I do think the underlying continued requirement for industrial and the limited land argument is really quite robust. So I think, again, any investment, particularly commercial property, is a long-term investment. So I think that you will see growth, maybe not today or tomorrow, but in the short to medium term, you certainly will. Also, the requirement for medical maintains. Like, we have more people here, we have an aging population, and then we also have on the flip end of that a young population too. So there is a lot of requirements for that really young, under 5, and then the over 60. And then in the middle, while we're talking about people that don't have enough money to pay their bills, but they'll go and do injectables and they'll go and do cosmetic surgery, or they go to the gym, so they need the physio and then all those other allied health services. So yeah, that's probably where I'd be looking.
Oh, there it is, guys. Is that a national thing? Do you think that's a demographics thing, or is it a West Australian thing?
I think overall, I think that it's pretty sound. I think industrial, like for example, industrial in Melbourne, I probably wouldn't go to. I still think retail. I still feel confident on retail. People do spend money and people do like to go to a shop. I think that the shops will look different. I think there's a lot of development to be had. We're not all moving to e-retail. On the bigger end of town, there's all those really big investments like data centres. None of
us have access to that.
Don't have that sort of money. But yeah, look, there's a lot of things. Cold storage, those big industrial. I think industrial land is at a premium in a lot of places, and because there isn't so much of it. So New South Wales, Queensland, WA, good examples where there is quite a shortage of industrially zoned land.
So industrial, medical,
retail.
What do we think retail? What do we think of, for example, petrol and childcare at the moment?
Yeah, still feeling good about those. I think that once we see these interest rates continue to reduce, we'll see people come back into that market. I think a lot of people, like you said, were sitting on their hands for a little while. I think the fundamentals, particularly for childcare, are strong because we do have that federal subsidies in place. We are having children. Like I said, there's a lot young population, particularly here. It's very location sensitive, though. I'll definitely make that comment. We're seeing in a lot of places there is oversupply in some markets, so just be very considered with where you're looking. Make sure you know what the supply pipeline is or what existing facilities before you jump in, because that's more than ever. It's important to really know that.
I think when you're going into commercial, if you aren't already in it, you should have good people around you advising you on the things you don't know. It's a lot harder to understand that than it is in resi on those nuances, but once you are in and you start to get a bit of feel for what modulates prices in these spaces like childcare, like medical, like retail, then you can start to rinse and repeat a little bit as well. Once you're onto something good in commercial, you can just keep running through that vein.
Yes, yeah, definitely.
Vanessa Rader from Ray White Commercial, thanks so much for coming in again, mate, and we'll hopefully have you in before the end of the year.
Okay, thanks, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!